and welcome to Finding Alpha. On today's episode, we dive into the cement sector, a sector that could see a major shakeup from the GST rationalization. What are the re-rating triggers and what are the stocks to invest in at this point of time? Welcome to Finding Alpha. I'm Nigel D'Souza in the Mumbai News Center. With me today is industry veteran Anil Singhvi, who's joining us. He's also the executive chairman of Shri Digvijay Cement. And we're also joined in the studio by Jashandeep Chadha, the Vice President Equity Research of Nomura. Well, thanks a lot, gentlemen, for joining in. Well, in the next 20 to 30 minutes, we'll explore the possible benefits of the GST cuts, what could spark a re-rating for the cement companies, whether it makes sense to bet big on the players or, in fact, look at the takeover candidates and what are the expectations we're building up for FY26. Well, thanks a lot, gentlemen, for joining in, and thanks, Jashandeep, for coming down to the studio as well. But Mr. Singhvi, let me come across to you first. You've been rallying for this GST cut. Could you tell us this GST rationalization, probably from 28% to 18%, will it bring real affordability or is it at best a sentiment booster?
Well, look at this way that today industry is paying perhaps one of the highest GST in terms of total collection. According to me, this year should be about 75,000 crore on cement alone, which is, according to me, even exceeding cigarettes. So that definitely 28% per se is a very high rate. Now, if it is brought down to 18%, would it spur demand? Answer is yes. For simple reason that prices which are about 325 rupees, 350 rupees will come down to about 325 rupees. If the industry passes on the entire reduction in the GST, which I think, according to me, industry should do it for the larger benefit of both industry and the consumer. So the short answer is, yes, it will spur the demand because in the rural areas, cement still is perceived to be a little more expensive on account of GST being at 28%.
All right, Mr. Singhvi, so you're impressed with that, but Jashandeep, let me come across to you. What do you think? A GST rationalization, will it be enough, to boost up sentiment, push through volumes as well? Or do you think at best you leave it to sentiment?
So, first of all, thank you, Nigel, for having me here. So, I believe, GST cuts will largely not impact demand as much. Okay. We believe, cement demand is inelastic to prices. It's not that the prices go down, people will start consuming more. The cement is consumed as per the project requirement, right? However, what I believe is that instead of, demand increasing, there will be an increased share of premium and category A producers. Okay. So, right now, what category A producers are selling at post GST, they will be selling at, closer to the level of what category B are selling at. So the price decline in category A gives an opportunity to the customers to upgrade themselves in the same budget. So I believe while the demand will, flow as we are expecting, but the share of category A and premium products will improve. Okay. So that's how we look at GST.
All right, Jashandeep, just explain this to us then. Because as you're saying, in cement, you have broadly three categories. Category C, which is cheaper than category B, and category B, which is cheaper to category A. Right. Now, you're telling us because of the GST rationalization, those that were earlier buying category C could probably move to category B, and those who are buying category B could probably move to category A. Could you tell us what is the pricing difference as of now if I look at category A, B, and C?
Right. So, Nigel, largely it's four categories broadly. Okay. There's also one premium product which comes above category A, but however, their penetration is less than, let's say, 3% right now. So, the price difference on an average is around 25 to 30 rupees between category A, B, and C. Okay. Right. So, let's say if there is a 10% decline in GST, which gives you around 27 rupees decline in the cement, retail prices, which means category A, after GST cut will be trading at what, currently category B is trading at. Okay. So, hence, without spending much more, increasing your budget, a customer will be able to buy a better category, brand. And normally, we believe that customers are price sensitive in India. I believe they are value centric. So, in their budget, they would like to have the best brand available. Best brand at the least cost, and GST rationalization will help you get there. Yes. So, right now, category A is around 40% of India market. I believe, if the complete, cut is passed through, we can see 55 to 60% penetration of category A by FY30.
Well, that is important. And if you could break it up for us as well, which are the players typically that come in category A, B, and C? I think there's a geographic element to it as well. So if you could just explain it to us with a quick example.
Yes. So, it's a regional business, but there are two companies or two brands which are category A pan India, Ultratech and Ambuja. Ambuja and ACCI combined, so Ambuja Consol and Ultratech both are category A players pan India, but then there are regional dynamics. For example, in South, Ramco is category A, whereas in East it will be a category C or category B player, right? Dalmia is category A in both the regions, East and South, but Nuvoco is category A, in fact even higher than category A in East, but a category C player in North. So they are regional dynamics, but Ultratech and Ambuja are pan India category A player, and they have the highest penetration in premium products also. So I believe they will be the biggest beneficiary if GST cuts happen.
Got it. So you're saying premiumization and better value product at a lower cost is something that could play out. And as you said, Ambuja as well as Ultratech, they are mostly category A, while others it differs from region to region. On Shri Cement, I think in East, they are in the lower category, but I think in the North, they are in the top category.
So Shri, historically has maintained a view of volume over value.
Yeah.
So they have always indulged in, having a better utilization and asset sweating than focusing on pricing, right?
Okay.
So they are category B in North. However, since last year, they have been doing a lot of work on their rebranding, launch another, Bhangur brand in the premium segment. And our channel checks suggest, since the start of this financial year, there has been the acceptance of their premium or category A brand has increased. So they are able to, narrow down the price gap between category A and them from 25 to around 10 rupees.
Got it. And actually in the recent past, Shri Cement has suddenly started focusing more on profitability rather than on volumes as, they have pivoted.
So value over volume.
We'll talk about that in just a bit. But let's get Mr. Singhvi back into this discussion. Mr. Singhvi, in your career, you have seen it all, right? If you could tell us, because a lot of investors would like to look at this old economy sector, which is cement, tell us what is that pivotal moment for a cement company which helps the company re-rate?
I think twofold. One is demand, definitely. Last year demand was just about 4-5%. I expect the demand to spur, and maybe it is looking for a trigger, and GST reduction could be that trigger. Demand should come to about 7-8%. So, and secondly, the consolidation. I think the consolidation journey has been very good. It got accelerated only in 2022 because hitherto Holcim, as you know, was not, participating into the industry's growth, either for consolidation or for organic growth. But I think 22 was, according to me, a complete change in the industry's profile. Today, the top 5 players own almost about 65% of capacity. I expect the consolidation to still accelerate, and that will be the trigger for industry's re-rating coming in. Though, of course, EBITDA per ton or ROE and ROCE continue to play in terms of what the valuation game should be. But the trigger for the industry, according to me, could be the GST reduction from 28 to whatever it is, 18, 15. And secondly, the demand impetus, which will come on account of rural market really opening up. With good monsoon and reduction in the prices, I think we're going to see some very, very high demand coming from the rural pockets. And consolidation still is an ongoing process. It's not complete yet.
Mr. Singhvi, I want to ask you a little bit more about that consolidation process that you're talking about. But Jashandeep, let me come across to you. According to you, what is that big re-rating event? We have seen it in the past. Suddenly you saw Dalmia coming into favor. We have seen how Shri Cement has got those premium multiples as well. So according to you, what is that re-rating trigger? And if you could delve a little bit more.
Yes.
Cost structure is obviously important. That's what helps ratings as well. And I think those that are backward integrated and they have that clinker advantage, they as well stand to gain. So if you could particularly dwell on both these two aspects.
Sure. So, cement is a commodity business at the end of the day. In any commodity, especially in cement, the industry is price taker. So for the industry to have a re-rating argument, there should be a trigger that shows that there is increasing pricing power in the industry, right? However, the utilization remains very low in this industry. So we do not believe an industry-wide re-rating is quite possible right now. Okay. But however, when we come to specific companies, there are certain events which cause re-rating. For example, an expansion of capacity into multiple region or a company from a multi-region becoming a pan-India player. For example, for instance, in Ultratech, from FY16 to 18, their cement capacity, grew at a CAGR of 20% versus 6% for the industry, which led to their re-rating happening. They expanded, it was also supported by a lot of inorganic expansion, but they entered into multiple regions.
Yes.
Similar case we can see in Shri Cement from 13 to 16, they expanded a lot. And in Dalmia's case, if we see, there was a slight re-rating when they announced that they will be acquiring JP. So they will be entering center. Again, a step forward to becoming a pan-India player. But when that did not play out, the re-rating happened. So I believe for a company, the first thing is how much, geographical presence you have. So multi-region or a pan-India player will always have a higher rating than the other. Second, as a commodity, at the end of the day, it's the cost structure that governs it, right? The lower you are on the cost curve, the higher incremental ROCE you will have. And that's why Shri Cement, despite when they had some, market share loss or reduction in their volumes, their multiples continue to rate higher because they are one of the lowest cost producers.
I just want to come on to that point before you move on to the clinker aspect. When you're talking about low cost producer, better ROC, could you tell us for Shri Cement, what are the numbers, what is the industry average, and what is Shri at in terms of ROC? Because that is one of the reasons why Shri gets those premium multiple.
Sure. So if I take 10 years from FY22 back, the industry, the average ROC post tax was around 10% for the industry.
Yeah.
Around 10%, 9-10%. But at the same time, Shri was around 12-13%.
Okay.
So that's a big difference, and that is largely because they have worked on their cost. They are one of the company with highest green power mix in the world right now in cement industry, around 58%. They have worked on a lot of other things that has resulted in them being on the lowest end of the cost curve.
Yes.
So that advantage they have when even the pricing unfavorable, their EBITDA per ton largely sticks.
Yes.
Whereas other fines is difficult.
So got that. ROC of 13-14% in comparison to the industry average of around 10%. So Shri, one is the cost aspect. It translates into better ROC historically. These are the details. And on the clinker aspect?
Yes. So, when I say multi-region presence, I am talking about clinker. So at the end of the day, clinker or limestone reserve, to be very honest, are the key ingredient for cement.
Yes.
So every cement company is basically a limestone miner.
Yes.
Because they have legacy mines. So if you have clinker plants at different locations, you can set up grinding units near the market. Hence, you have a couple of things. Firstly, your freight cost to the market goes down. So you have a cost advantage. For example, Dalmia, I'll take. In East, most of the clinker reserves or, limestone reserves are in Chhattisgarh.
Yes.
Everyone has a clinker plant there. However, Dalmia and, Shiva Cement, which is a subsidiary of JSW, have clinker plants in Odisha. Now, what happens is because of this, they can provide, cement to places like West Bengal or Bihar at a lower freight rate. So hence, their profitability increases in that. So multiple, when I talk about regional presence, I'm talking about clinker and not cement.
Got it. And just on the cost aspect, the cheapest cost cement producer is who? Shri.
So it is, Sagar and Shri. So very close, but Sagar has also been a low-cost producer. But in larger players, players above 20 million ton, it's Shri, definitely
Okay.
Shri.
Shri and Sagar Cement, they are the lowest cost producer. Got that. Mr. Singhvi, let's come across to you. Elaborate a little bit more on that point you made about the consolidation theme. And are we due to hear something about the company that you're heading? Shri Digvijay Cement, is there something in the near future with regard to this consolidation drive?
I am right now talking about larger picture. So let's not talk about the micro and small picture which is there, which is not going to move the needle of the industry at all. In fact, when you look at the total capacity of the industry today of 650 million approximately tons and demand this year of 500 million tons, still the large players are, I think, just about close to 400 million tons, which is of the capacity is just about 65%. I expect this 400 million tons by the top 5 players to go at least up to 500 or 550 million tons before we start seeing the real benefit of consolidation coming in. So according to me, the consolidation is a journey, and I think we're going to see it much more in next 1 or 2 years' time. And I would stop it at that as far as consolidation of the industry is concerned.
We'll be waiting to hear from you, Mr. Singhvi, whether or not Shri Digvijay Cement, there's a deal in the offing. But as you said, we'll keep that aside for now. All right. Before we let you go, Mr. Singhvi, could you tell us when do investors need to be a little bit cautious on cement companies? Sometimes, over-aggression, wanting to expand everywhere. I've seen that in the past as well. Tell us more.
I think two things very clearly, perhaps you answered the question itself, is that aggression in volume game. You cannot create the demand. The demand will take its own course. So there's no point in pushing the volume just because you want to have a market share. That's actually just a very, very nominal push one can have it on that. But oftentimes we are seeing that just you're getting a 1% or 2% or additional market share, you're dropping the prices by 10%. Cement is actually, to that extent, is a highly competitive landscape. In that, if you try to gain the market share in the shortest possible time, I think that takes the toll on the market and the pricing. I, for one, have seen in the last 40 years that finally you are a long-term player. You don't have to look at one quarter or 2 quarters for your market share gain. Gain will come definitely because the industry itself is going 7-8%. But if you wait and watch and see and don't spoil the, so to speak, the market sentiment, I think that then it's a long-term haul. And I'm glad that with the consolidation now, the serious players are emerging. Those who are to create a moat for the investors, they can't just look at capacity and the capacity utilization. Both of them are actually at the two ends of the spectrum. So look at what your capacity utilization is. It has to be in excess of 80% for you to create really good value for the shareholders on that. So I'm sure, I think going forward, this will be played out in a much better manner than what we have seen in last 1.5 years. Demand definitely played the spoil sport. I hope and expect the demand post, maybe that's a trigger which I'm still hoping the GST reduction should be the trigger for the demand to spur down.
You're extremely happy with this GST rationalization, Mr. Singhvi. We thank you for joining in and filling us in with your views on the show. Jashandeep, coming across to you before we take a mandatory break. The street is divided. Should you look at the big boys, the ones that are ruling, Ultratech, Ambuja, Shri, Dalmia, should you look at them? Or should you look at the smaller ones, which trade at a sharp discount in comparison to replacement cost, and they could possibly be takeover candidates? Where are you placed out there?
So I'll answer this in a different way. How basically that's the question is whether the consolidation will increase or not.
Yeah, Mr. Singhvi believes it's going to go on.
Yes, I believe the consolidation in any industry, especially where the utilization is low, will happen. But what we have to think about how the pace will be from here on.
Yeah.
I think the pace will temper from here. The pace will decline from here. It will not be as aggressive as we have seen in the last 2 years. So just to give you an instance, from FY14 to 17, around 12% or 51 million ton of the cement capacity exchange hand. Since the entry of Adani from FY24 to 25, already 63 million ton have exchange hand. So that's roughly 10% of the industry. I believe from here on the consolidation pace will go down, because if we look at two metrics, right? Firstly, the we look at share of top 6 and top 3 players across the regions. So if in the case of top 3 player share, it's already above 50% in all the region except South and East.
Yes.
And in case of top 6 players, it's already above 80%, way above 80% in all the regions except South. So I believe any more inorganic, significant inorganic expansion might result in Competition Commission, coming in and checking in. Plus, there are not many, stressed assets also that companies will be looking to buy at a discount. So I believe the consolidation will happen. Companies like Ambuja, still have to expand their capacity by 20 million ton, and inorganic is a easy way to do that. Sorry, not easy, but it's a quick way to do that.
Yeah.
But the pace will not be as we have seen in FY24 and 25.
So consolidation will slow down. It could happen, but it will slow down. So you rather stick to the big boys.
Yes, I'll stick to the large caps.
Got it. We got some more questions for you, Jashandeep. For the time being, we'll take a short break. You come back. We've got a lot of queries as well because you'll have written in. Stay with us. Jashandeep will answer all of them. Welcome back. You're tuned into Finding Alpha. You're on CNBC-TV18, and we are in conversation with Jashandeep Singh of Chadha of Nomura, who joins us. Jashandeep, two numbers I want to get out of the way. One is on volume growth. Mrs. Singhvi is sounding quite optimistic that volumes are going to recover in the second half of the year. The first half actually has been soft. What volume growth are you factoring in for the industry? And EBITDA per ton is expected to improve. How much it improves for the industry in 26 versus 25?
Yes. So talking about volume, I think I am also very positive. The fact is that around 55-58% of the total volumes come in the second half. So there's a majority chunk of volumes which is still yet to come. Okay. I believe this year, FY26, the industry should grow between 7 to 8%. Okay. YOY. And on the EBITDA per ton, I believe last year the EBITDA per ton was a little suppressed because there was, pricing were very weak. Yeah. Prices have recovered, strongly. Even in a monsoon quarter, we are seeing pricing being resilient. So I believe around 200 to 250 rupees per ton for the large players, it is quite possible. On an industry-wide, I think 100 to 150 rupees per ton is quite possible.
Got it. Okay, Jashandeep, we have a couple of viewers who are listening to what you have to say, and they're looking at the charts and they're saying you have buys on a couple of stocks. So Rohan Sharma is writing to us from New Delhi. He's saying between UltraTech and Shri, he wants to know which is the better placed company according to you. You have a buy rating on both of them. What's your take?
So yeah, so to answer between UltraTech, so right now both the companies are, doing something which the other company used to do earlier. Yeah. So Shri Cement is on a path of improving their realization. UltraTech is already a category A player who's, on a path of cost reduction. I'll say that, very close, but I'll go with UltraTech because I think in a commodity business, cost reduction will provide you, sustainable EBITDA per ton reduction. Shri Cement is on a path. The absolute, the total volumes to be upgraded will take some time. Okay. So I believe UltraTech will see, better delta in EBITDA per ton than
Got it. All right. So UltraTech over Shri, it's buy rating on both, but preference, UltraTech comes first. Ravi Kumar as well has written to us from Chennai. He has around 500 shares of ACC at 2,300 rupees. Wants to know what's the outlook on this one. Valuation comfort, large player, but still that's been a big underperformer. What's your view?
So we have a structurally negative view on ACC. We believe there are a lot of structural challenges in the company. Okay. I'll not, the prices are at 2,300 he has booked, right? Yeah. So what I'll suggest is to wait for, some price increase and then shift. If he wants to play in the Adani group only, then shift to Ambuja or, switch to some of the large cap players.
Ambuja over ACC, and I think that's what the street as well. And that's why it's been getting those multiples. So we got that. But there's another interesting, query that's come in from Riaz Khan, who's written to us from Hyderabad. He holds around 225 shares of Deccan Cement at 628 rupees. Wants to know the outlook on the stock. I have my ear to the ground. And I try to find out who's visiting Deccan, who's interested in, what kind of assets they have, what is the capacity expansion. What do you believe? What should he do? He's nearly doubled his money, but that bride is still out there. The groom has not yet been found.
So, Nigel, I think you are at more liberty to talk about Deccan Cement. We don't cover that south, so I won't be able to give my opinion on that.
But what's your view on South India? In South India, do you like anything? Because these valuations give you comfort. The problem is capacity utilization level is so low. Now there is hope that, utilization will improve and pricing has improved after being a big underperformer for the last 12 months.
So what I'll suggest, to the viewer is that if they want to play in South India, I think Aramco Cement and UltraTech or even, Ambuja might be a better because they will see sustainable increase in their EBITDA per ton because their volumes will expand more than, I think UltraTech and Ambuja's volume will expand more than the industry. And Aramco, once the pricing come back, is closest to the highest price market of Kerala and South Tamil Nadu. So there's one advantage over there as well. So either, play with, if they want to do a mid-cap player, Aramco, otherwise UltraTech and Ambuja.
Okay, all right. Final question, Jashandeep, before we let you go. What is the risk to this entire thesis? That cement, people are quite positive actually because Q1 for the market on the whole has been soft. But cement has been showing that, maybe the second half is going to be much better. It has a low base effect as well. So what do you think is the risk to this thesis?
So for any commodity industry, right, these stocks react to how the pricing is going, but the structural risk is always the demand. Yes. Right. So I think if now we are also seeing the government stance is changing from more of, more towards consumption, right? So if the government demands, declines, I believe then we might, all the price hikes might not be able to sustain. So the failure in demand is the biggest risk than any pricing, I'll say.
Okay, all right. Well, Jashandeep, it's been a pleasure having you on the show. Thanks a lot for joining in, telling us about the various aspects, not just pricing, but within pricing, there are various categories, the way you're looking at the industry with regard to the cost focus as well. And GST could in all probability at least help, on the volume parameter, hopefully. But more importantly, it'll help in premium use of cement. Thanks a lot for joining in. Well, on that note, though, we'll wrap up on this edition of Finding Alpha. Thanks a lot for watching.